Hey guys, Tish here from Black Sheep Finance. I hope you're having an awesome weekend. So today I'm going to be talking about interest rates, because the first thing people do when they find out you're a mortgage broker is they go, what's the best interest rate? Unfortunately, that's not an easy question to answer because interest rates aren't that simple. They're very, very complex. Every bank offers different interest rates to different kind of people, and it's all based on who you are and what your own financial position you're in. So the thing that I find really annoying is that people see all the ads on TV where you see the special for whatever interest rate, but everyone ignores the fine print. Normally there's a paragraph like that big below the interest rate they're advertising, which says, oh, loan must be 500,000 and LVR not exceed 80%. So obviously until you start to learn and understand what these terms are, you don't really understand why you can't get the best interest rate. It's not always about the best interest rate. The way I work and any good advisor works is we look at your situation first. So who your income, who you are, what your income is, how much deposit you have, what your LVR is. If you don't know LVR, look at the 5 Essentials video to find out what that means. Everything to a bank is based on risk. So the riskier you are, the higher your interest rate. The less risk, the lower your interest rate. And every bank advertises it differently, and obviously whatever the interest rates that are today, if you get the best interest rate today, good for you, but it won't be the best interest rate tomorrow. Interest rates are always constantly changing. A lot of people think they only change when the RBA changes, which is not correct. A bank is like any other business. They're constantly releasing specials, constantly playing with their interest rates and products to get more business. So a lot of people try and refinance to chase the best rate. You should really only look at refinancing based on your position, if you want to get more equity out, if you want to go on a holiday, etc. So I actually am going to show you my software here and show you what today, so I don't know what today is, it's Sunday, the 5th of February. These are rates current as of today. So I'm going to flip it around. Okay, so here's my software. So I've got access to 23 lenders in here. I do have access to more, but I don't use all the lenders. So let's say, well, let's use this example. You've got $250,000 loan. Well, that's unrealistic. Let's put this up. Let's say you got $350,000, and your LVR is 80%. So over 80%, you're going to be in lender's mortgage insurance territory. The rates are also different depending on what it is. Is it variable? Is it fixed? The 1-year fixed rate is always going to be different to the 5-year fixed rate. Let's just keep it variable for now. The other thing that's changed recently is property use. So only a short time ago, whether you used a property for investment or you actually lived in it, the interest rate was the same. That has now changed. So I'll show you owner-occupied rates. 80% 350 variable. Nothing else is really going to change at this stage. Let's do a search. Just going to hide this. Hang on. Okay, so it ranks it in alphabetical order based on the lender. Let's hide this too. And change this. So just because these rates are here, so in this column, this is where a broker comes in handy, because there's literally here hundreds and hundreds and hundreds of products. You need to know what the difference is between all the products, and that's what a mortgage broker can help you with. So it's not, you can't just look at this rate. This is the initial rate, as you can see here. This is the I guess, advertised rate. What's important is the comparison rate. I'm going to do comparison rates in a separate video so you can understand how that works, because it depends on what the comparative terms are in terms of a loan amount and year. What comparison rate essentially does is it goes, okay, let's look at, that's a good example, this Bankwest product here. So the advertised rate is 3.85. I'll just come in closer. But then we've got fees. You've got an upfront fee of $250, and then you've got an annual ongoing fee of $395. So if you include all those fees into the equation, which you have to because you pay it, the rate's not actually 3.85, it's 4.26. Obviously this is over a certain time frame, so I'll go into that in a separate video. So you can't always pay attention to the advertised rate, which is there was a reform that happened restricting banks and lending institutions from not, I guess, they would subtly make the comparison rate in small print. They're not allowed to do that anymore. So, you know, the average currently, if you have an LVR of 80%, you can get rates below the 4s. So there's lots of lenders here that are offering rates below 4%. If we go over that 80% just quickly, let's say you're at 95 because you haven't got much deposit. So the higher LVR, the higher the interest rate, because it's higher risk. So again, go down here, change this around. So again, unless you know what all this means, you go, oh, well, these rates are cheap, but all these products are listed here, as you can see, introductory products. So it means they're only cheap for the first couple of years, and they revert to a much higher interest rate, which is what this revert rate is here. So the an actual standard loan here, which is with Bank SA. So Bank SA are pretty good with their basic products. I'm just going to flip it around. So it's important to understand how the banks, how their products work as well. So normally a bank will have a packaged product. The packaged product has annual fees, and you get offsets. Offsets I've done in a separate video as well. So you get cooler features and you don't get charged fees often when you want to change things around. A basic product, yes, you get a cheaper interest rate, but anytime you want to change anything, normally there's a fee involved, and you generally can't get an offset. That's the main sort of difference between those products. If you go into a bank, I don't want to say, you know, probably 8 times out of 10 they will probably suggest the package product. Most likely because they get better bonuses when they see you into that product. Not everyone is suitable for a package product. It depends what your loan amount is as well. So there's so many variables when you're looking at interest rates and products. And that's what a broker does, basically, is they navigate the whole market for you. When you go into a bank, they're only going to offer you their products. They're not, if you go on a CBA, they're not going to go, oh, actually you should go to ANZ, or actually you should go to Bankwest. That's not their job. They will tell you whatever they have to offer. And a lot of brokers as well, because there's so many lenders, like I've got a panel of 23, it's really difficult to be across every single lender. Most people who work in just one bank don't even know all the products that they have available to them in that one bank. As a broker, imagine knowing the policies and products of every single lender is almost impossible. So that's why we do scenarios. Whenever we have a client come to us, a good broker will take that client's situation, their scenario, and they will pitch it to several banks to find out which bank is better for them. I think it's, if a broker straight away goes, oh, you should go to this bank, it's more likely they only choose to deal with that bank because it's easier to deal with just one bank. I prefer to give the best situation for my clients, understanding their situation, and then shopping for the best rate. So say, for example, if you're at 95%, you've got low deposit, and you've got casual income, less than 12 months, so you're not going to qualify for all of the banks. So we first look at your situation, and then we look at the best rate. It's not the reverse. It's not, oh, that's the best interest rate, I'm going to apply to that bank. Because if you don't fit their policy, you'll just get declined. And even though you can obtain finance somewhere, you've now got that decline on your record. So you need to know what your situation is first before you go shopping. I'm just going to quickly show you what happens when it's an investment rate. Flip this around. So you can see here, when it's, you know, if you've got a rate probably unoccupied home, anything at about 4.3, you can definitely do better currently in this point in time. If we go to investment and go back to 80, like this. So investment, what products would be applicable here? So under 80. You get a range here of about 4. Realistically, you're looking at about 4.2 for investment rates. 4.2 upwards if you're under 80%. 4.34. So 4.2 to 4.4 is pretty standard for investment rates currently. If we go to 90%, and we're looking probably starting from 4.3 up to probably 4.6, 4.7. So as you can see just from showing you my software there, that it depends a lot on what your lending ratio is, whether it's owner-occupied or investment, and also whether it's fixed or variable. I'll probably have to do fixed and variable that versus in a separate video as well. When you're looking at fixed, currently fixed rates are cheaper than variable, but that doesn't mean it's the best option for you. You really need to know what you're doing now, what you're doing in the next 2, 3, even 5 years to figure out what product is best for you. So, summary is that it's not always important what today's best interest rate is. It's more about you, what your situation is, and what you're trying to do into the future. And a good broker will look at your whole situation, including the future and all your goals, and then guide you into the best product from there. So hopefully that's been insightful, guys. Obviously, still the goal is to get your best interest rate, but it's more important who you are and what you want to achieve first. Enjoy the rest of your Sunday. See you guys.